If you watched the election last night, you may have noticed that once it became apparent that Trump was going to be victorious, that the markets around the world started declining and also the futures here in America started declining. That probably caused a lot of people some anxiety. And actually this morning we've already fielded a couple nervous calls because the markets were down so much last night. Let me first explain why that happened and why this happens in the markets, what we're doing about it, and also what you should do about it. So number one, the reason why this happens is because the markets don't like uncertainty. They prefer when the expected is going to happen. And a Trump victory was unexpected to the market. The market was factoring in a Hillary win. And it's not that the market necessarily thinks that Hillary would have been a better president for the economy than Trump. It's the fact that you knew what you were going to get with Hillary, whereas there is the factor with Trump that you're just unsure. Even though a lot of his policies are very pro-business, lower taxes, lower regulations, usually things that are good for the economy, it came with the uncertainty of, is he going to say the wrong things? Is he going to mess up foreign relations? Some of these things that cause the market some uncertainty. Okay, so that's the reason why the markets drops. The market does not like uncertainty and the unexpected happen, and that's what happened last night. So going forward, as of right now, at about 10:30 in the morning on November 9th, the day after the election, markets actually have come back, and the Dow even broke positive early this morning. So now, we wrote in our market commentary in the beginning of the fourth quarter, early October, that the two most likely scenarios of overall political power was a Democrat president, Republican Congress, Republican Senate, and the second most likely scenario, which is what happened, a Republican president, Republican Congress, and Republican Senate. Both of those scenarios, historically, since 1949, have had good market returns. In fact, when there's a Republican president, a Republican Congress, and a Republican-led Senate, the market's averaged about 15% per year. Now, that happened 6 times, so it's a small sample size, but since 1949, that's actually what happened in the markets. That was a study done by JP Morgan. Feel free to read that commentary to learn more about that. Now, from the standpoint of what we're doing about it, I mean, our investment philosophy hasn't changed in that we manage risk first. Okay, so we're always looking to preserve our clients' capital and try to create portfolios that take on significantly less risk than the market. But at the same time, opportunities may arise through volatility where markets drop, where we're going to be looking for opportunities of how to help our clients' portfolios grow at a faster rate. So we will definitely be trying to protect and also looking for opportunities. Now, the last thing I will say is try not to allow short-term volatility to cause you to make emotionally based decisions. Try to stay focused on the long term. And most importantly, focus on what you can control. You know, you can't necessarily control what the president is going to do, but you can control your day-to-day decisions in your financial lives. So I hope this helps. If you have any questions, feel free to give us a call, and we're happy to go into more detail. Have a good day.